In the previous reel, we learned about repo rate. Now, let's continue breaking down other monetary policy tools used by the RBI. Firstly, let's talk about the legal reserve ratio. It basically means the minimum amount that the commercial banks must set aside and cannot lend. There are two types of legal reserve ratios, cash reserve ratio and the statutory liquidity ratio. Cash reserve ratio basically means the minimum amount of cash reserves that the commercial banks have to maintain with central banks from the deposits that they receive. Statutory liquidity ratio basically means the minimum amount of liquid assets that the commercial banks have to maintain with themselves. These liquid assets can be gold or government securities. Now, when RBI increases these legal reserve requirements, it reduces the lending capacity of commercial banks and therefore controlling inflation. On the other hand, when RBI decreases these legal reserve requirements, it becomes easier or increases the lending capacity of commercial banks and therefore supporting the economic growth. Now let's talk about open market operations. It basically means buying and selling of government securities by the RBI from the open market. Now, for example, when RBI buys these government securities from the open market, it pumps the money into the system and therefore it supports economic growth. Whereas when RBI sells these securities into the open market, it reduces the money supply in the economy and therefore it helps in controlling inflation. And this is how RBI uses these monetary policy tools to control inflation and support the economic growth and stability of the country.